And Mark, this is a great time to talk about maybe the differences between a broker, a bank, and a non-bank lender, because
Sure.
although the products that a consumer will receive can be similar, there's a big difference between those three, correct?
Yes. Yes, there are. So, and they all have their place. Okay. Uh, Broker is a guy who takes your mortgage application and then places it with a lender, and the lender does the rest. They underwrite the loan, they close the loan, and they collect your documentation. Okay. A non-bank lender is a direct lender. They close the loan in their own name, but all they do is mortgages. They don't do anything else. Many of them, like us, are almost like a hybrid of a broker, because we're not big enough to sell loans to Fannie Mae and Freddie Mac. You have to be huge to do that. So we're selling loans to a variety of outlets, and some of those outlets have appetites for different types of loans. Like some like multifamily, some don't. Some like investment properties, some don't. Some are more forgiving for credit scores and debt ratios and so forth and so on. So it gives us a variety of interest rates and a variety of outlets for loans. So with a non-bank lender, you get that. When you go to a bank, you go to Chase, you go to Wells Fargo or PNC or wherever you go, you are then stuck with whatever they have an appetite for, whatever their interest rates are on that day. And for instance, and I don't know if this is still true, but in my experience years ago, Wells Fargo, their big thing was debt ratios. So if your debt ratio went over 42 or 43, they were not going to do your loan, no matter what the mitigating circumstances are. You're applying for a $500,000 loan on an $800,000 house, and you have $5 million in the bank. Your credit score, your debt ratio is high. They don't care. Bank of America, it was credit score. That was their big thing. So if your credit score was 640, they weren't doing your loan, even though it met guidelines. And plus, the big banks do not want to do government loans right now because they got killed when they bought up a bunch of these small non-bank lenders that had committed fraud on FHA loans. So they don't want to do those loans now. So it's all, but on the other hand, if you're in the private banking part of, say, Wells Fargo, a non-bank lender just can't match the interest rates you're going to get on a jumbo loan. That's the bottom line. So every lender has their place and what they're good at.
Which is another reason to interview many, so that you can
Right.
better understand your circumstances, so that you can go with the lender that will best suit your needs.
Correct. And one of the biggest things to watch out for is in-house mortgage companies. That lender does not work for you. They work for the real estate company.
Yes.
Their livelihood is dependent on doing what the real estate agent wants them to do, whether it's in your best interest or not. I know their fiduciary responsibility is to the borrower, but let's face it, if you're sitting in a real estate office with 50 real estate agents and they're feeding you your livelihood, you're going to do what you have to do to keep your job.
Yeah. Well, and that's something for sellers to look out for too, right? When they're
Correct.
taking, pre-approvals or pre-qualifications from in-house lenders. Not to say that they're bad. There are some great in-house lenders who do a fantastic job, of course.
Correct.
But it's just something to say, okay, maybe we should just ask a few more questions.
Right. Or get a second opinion.
Yes,
Correct.
absolutely.